Hey everybody. Just give me one quick minute here. All right. I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. I no longer have path. I got out of that on Friday. Everything else is pretty much the same. Was very, very, very net short at certain points today, which wasn't easy, but worked out. Even though the SPYs here are only down 0.2%. It's like nothing. Qs are down 0.6%, so that's where your weakness is. The IWM is up 1.8%. So I mean, we really got the perfect rotation day. This is exactly what we've been looking for. Yeah, perfect rotation. Just big outperformance from the IWM compared to the Qs. Let's pop over to some daily charts and analyze this a little bit further. So starting with the SPYs, SPYs giving us a little bit of a shooting star here on the daily candle. We had gotten decently extended at highs, but not really hitting that extreme territory yet. So let's see here. At highs, the SPYs were 503.50 with the ADMA at 496.25 is where we are currently. So I don't know, about $7 worth of extension. So solidly into that no man's land that I'd like to say is between like $4 and $9 of extension, but not really extreme. But it has been this steady grind higher where we really haven't touched the ADMA on the daily since the beginning of the month. I'm trying to remember what caused this pullback on the last day of the 31st. Was that the Fed? Was the Fed the last day of the month last year? I mean, last year. Wow, I'm really losing it. Last month. I guess that was the Fed. Yeah, so Fed there. So we really haven't touched the ADMA on the daily chart since that occurred. We have a little bit of a push through failure here today, a little bit of a shooting star candle at the end of the day. This typically indicates that the market needs further correction. So it could be through time or through price. We could pull back very easily to the ADMA and it won't even look like anything. You know, a little, maybe a retest of this breakout area that we broke out from around 494 to 495. The deeper pullback would be 489 to 490. The 21 EMA, even that's not necessarily the end of the world. A deeper pullback into the equilibrium area. CPI will obviously have a big effect on that. With the CPI, we could easily just get right back above the shooting star high, which tends to be the lower probability situation when you get this type of candle with some extension. But we know that big news events, macro news events, they can just totally change the technical picture very quickly. But otherwise, it looks like the S&P is set for some more correction through time or through price. Qs here, similar but different. Little bit of a topping tail through Friday's high, so also indicating that we could use some further correction. We recently had a really big breakout at 430. A retest of 430 would not be the end of the world. As a matter of fact, it'd be pretty healthy. You could even pull back deeper. The 21 EMA is all the way at 424, so that is all fine. And the IWM, beautiful takeover of relative strength. They really took the baton. Great continuation. It's a big day 3 today for the Russell. We were looking to see if the IWM, if it could really recapture that 196 and 198.50, if it could break higher, and it did not disappoint. Almost getting extremely extended at a certain point. With the IWM, it's usually like $7 away from the ADMA that the market starts to become, more extreme in terms of its extension. And a 204, you're there, basically just at about $7 of extension. Here at 203, it's solidly in that no man's land. So Russell looking great. Really, we got the rotation trade today that we've been looking for. But keep in mind, when you start hitting that extreme level of extension, it makes it very difficult to buy. So that's kind of the update on the market from today. Obviously, this is all going to change tomorrow with the CPI. But the technicals here, I think pretty much across the board are telling us to take a pause on buying. The SPYs and the Qs, they're letting us know that a correction is needed. And the IWM, while it's starting to look fantastic and it's playing a lot of catch-up, is getting extended enough that it's also saying, hey, be patient, be careful on new longs. So that was, that's been the thought process at the end of last week and into the beginning of this week, though, I kept remarking as I was starting to short semiconductors and the NASDAQ a little bit more heavily at the end of last week that I felt like I was maybe just a little bit too early. This week I feel a little bit more comfortable because we're approaching some of these big options expiration dates. We got this VIXpiration date on Wednesday. This one's particularly important because there have been some really, really big VIX calls that went off in the last couple of months that are expiring in February, though there are a lot more big VIX calls that are out to March and April, so maybe we see those get rolled a little bit over the course of the next couple of days. That's obviously to be determined. So the VIX itself is really on my radar because we have been in an environment the last couple of trading sessions, and it continued today before the market rolled over a bit, where we were seeing market up, VIX up. And at a certain point today, it was the third day in a row on that. And I want to pay close attention to the actual price of the VIX, and I've been looking at it all day. Where did the VIX close? Under 14, right? 1389, if I'm seeing that right. 1393. Yeah, so under 14. Somewhere above $14, if the VIX can do it relatively soon, I think could be a trigger point for this market that causes a lot more people to actually have to chase the VIX higher to get insurance on their long positions, as positioning itself has gotten a little bit more stretched. So I put in the note this morning that if the VIX itself can get to this 1450 area, that you might be able to look for short-term momentum trades by buying a UVIXY or a VXX, or possibly even buying VIX calls. So I still definitely have that on the radar here over the course of the next couple of days, especially with CPI tomorrow morning. A few days in a row of market up, VIX up. Can't last forever, but it certainly can last for several trading sessions or even as much as a week. But I actually think it's a situation where the higher the price of the VIX goes right now as we approach this upcoming options expiration, the higher the probability that it feeds into itself, that makes for an even bigger move higher, and therefore can hit the market down a little bit also. So I would really pay attention to the VIX over the course of the next couple of trading sessions. If we start getting above 14, noticeable, but if we really start clearing through that 1450 area, personally, for the moment at least, I'm kind of game planned to come in and buy a bunch of VXX or UVIXY to see if some acceleration actually comes in. And this is as I've gotten pretty short the Qs, but the trade off the Qs is really just kind of a second trade off the semiconductors, which I'm also pretty heavy short, like this SOXL. And you can see if you look at SOXX, you look at SMH, they gave some solid shooting star candles on this day 4 to the upside, with some of those names becoming absurdly extended as far as the move goes. So I think that the timing on that was pretty good. We came in this morning, we talked about, maybe you can look at for an SMCI short. Not an easy trade, don't get me wrong, not an easy trade trying to short the strongest name in the market. And we probably tried it a few times before we actually were able to capture it in this $800 area. The shooting star came in at 1135. That was finally the signal but certainly not easy. With that said, off of this topping tail in SMCI and the semiconductor ETFs, um, I mean, I think a pullback to $700, if it pulls back, if the momentum abates, which we saw some of today, a pullback to $700 should be easy, to be totally honest. It should be an easy pullback if the momentum no longer abates. And what I was saying in the morning meeting, and I'll stick with it, is, as a matter of fact, I think that if you are able to capture like this SMCI short or some of those other semiconductors, you should keep a small position, especially because the short itself is so hard for a really, really big move. And by really, really big move, I really just mean a move back to the equilibrium zone on the daily chart for the stock. But given the degree of the upside extension and the degree of the parabolic move that SMCI is given, that is a really big move. So, that's what I was saying. If you're going to put the work in to try to short this insane stock today, which was not easy, but if anybody was able to capture it, please, please, please don't all be at 100% of your position by 765. It is not enough reward for the difficulty and the work of trying to actually capture this thing short. Keep, probably not a lot, again, get the risk covered quickly, cover even more than your risk very quickly. But from that point on, keep 10, 15, maybe even 25% of your position, depending on how greedy you want to be, for at least a test of the ADMA on the daily chart, if not a deeper pullback into the midpoint of this equilibrium zone, maybe somewhere around $600. And then all of a sudden, if you were able to, which was definitely not easy, like capture this high in SMCI here and short with $8 worth of risk, which is still a lot of risk, please make sure that you're getting rewarded for it, because that $8 worth of risk on a reach target could be $200 worth of reward, and that's not a bad risk reward. So that was kind of the biggest thing that I was looking for in today's trading session was, do we finally hit the point here with these semiconductors? I think the SMCI RSI on the daily was at 94 or something like that, and that was pre-market when we were doing the morning meeting, even before the high came in. Just make sure that you get paid on it. I know for myself, like this SOX L short that I have on has not been an easy short. It really has not. And I started a little bit too early. I knew I started too early at the end of last week. I said out loud, I think I'm starting a little bit too early, but I definitely made sure to create a game plan for myself that could let me build in. And even with that, at highs today, I was looking at my sizing in it, and I was like, holy crap, am I heavy in this thing for a 3x levered ETF that's short NVIDIA and and all the rest. But it's the same deal. Not an easy trade, but I'm following through on my game plan, and I'm damn going to be sure that I'm going to get paid for my risk if the trade works. I'm going to make sure that I follow a good game plan that can maximize my reward on the downside. So it's a really interesting market as we're in week 15 out of 16 to the upside after last week or something like that. The trend is still absolutely your friend, and I don't want to deny that. The best trades of the year so far have been identifying these pivot lows in the marketplace and just going with the trend and going for that continuation. That should not be ignored. I still will not come out right now and call a top, as much as my thought process has switched from bullish to increasingly less bullish to much less bullish to, dare I say, bearish within the confines of an uptrend. The uptrend itself has to be respected. So at the moment, all we have here is a little bit of a topping tail that indicates that this market could weuse some price or time correction. And then once again, this could all be out the window on the CPI tomorrow. CPI comes in hot. We'll probably get some technical continuation of today's upside tail. CPI comes in light. It could negate today's candle. And if it negates today's candle, this is the other thing I was talking about in the morning meeting. If you don't get the VIX to pick up through 14, through 14.50, $15 like we talked about, if CPI comes in light, the VIX can't go, and the market gets above today's high, then we could actually see one more much bigger parabolic upside move in this market, which I also think actually eventually leads to a pretty good shorting opportunity. But the point is, if you're short
right now, and I am even with the amount of stock that I covered on the way down today, I am most definitely net short. I'm not sure on what the ratio is. Let me do some math here. 9. Probably, let's see, minus, because it's hard to do the math because what I'm short is also 3x levered. So I want to multiply what I'm short by 3 to understand my true short exposure versus my longs. But I'm probably short versus long at like a 2-to-1 ratio at this point overnight, and it was significantly more than that at one point intraday today, and I probably covered 30% ish of my Q short, and probably similar or a little bit more of my SOXL short. But yeah, I was just massively heavy in both of these at a certain point at highs today. So even with the amount that I've covered, I'm still probably short to long at two to one right now. So we'll see. And even with that, I think it's just very important to remind myself, and we should all do the same thing. I'm not smarter than the market. I'm not better than the market. The uptrend is still intact. My risk management is always going to be paramount, especially when you're trying to do anything counter trend or counter momentum to the market. I just think that with where we are right now, there's a lot of information out there, positioning information out there, again, that indicates that we could see a deeper correction this time around. It's similar but different, I think, to some of the data that we were looking at the July top, where positioning was starting to get a little bit stretched. But I think that the big difference between where we are in February and where we were in July actually is the VIX positioning from the big players that are out there, with the calls that they've had that we were looking at even a month ago. We were looking at it in mid-January, that a lot of that stuff was set to expire in February, March, and April. And we're approaching that February expiration. It'll be interesting to see if we see a lot of that roll further into April and March, but there still is a lot out there for March and April also. And if you understand that positioning, I think that there is a real chance, and this is my worry on this market right now, that it actually leads to like a pretty big VIX breakout, which in turn has to hurt the equity market. So that's what we're always trying to do as traders, and what we're trying to do here as a team. And it worked so well for us, by the way, at the end of July, where we were able to combine. Again, it was different. It wasn't the VIX in July so much as it was just overall positioning. I actually think that long positioning was more stretched at the end of July than it is now. But the difference is that is the VIX positioning that we have now that we didn't have then. So obviously every situation is unique, but you combine that with something technical. So we were looking at the positioning being super stretched at the end of July, and then we had this push through failure here, which I think was some sort of news that day. I don't remember exactly what, on July 27th, which was our signal to be a little bit more aggressive on the shorts and look for a deeper correction. The deeper correction actually turned into a literal market correction, as over the course of 3 months it was an 11% pullback. Not here to say that is what's going to happen. I don't call tops as a rule. I just want to communicate the evidence that the situation that we're in right now could be indicating that a big correction could come in, and we'll take it one step at a time in the same way we did back in July. It started with the technical push through failure and understanding positioning, but eventually that led to a trend switch where the intermediate time frame uptrend broke, became an intermediate time frame downtrend eventually with lower highs and lower lows, and led to a bigger correction. So you don't need to pick the exact top if something like that's going to happen. And that's why I also want us just to be aware from a momentum perspective that I think that if the VIX can pop through certain levels, that it just becomes a feedback mechanism of market participants looking for more protection and needing more protection, just kind of feeding on itself, where you see the VIX shoot up even further, you see the market as a result pull down even further, and then you see potentially you could even see some of the the vol control funds become sellers at a certain point. CTAs might become sellers at a certain point. Trend following algorithms can become sellers, and that's how markets work, right? Markets work in feedback cycles. We have been in a feedback cycle that started at the end of October, which with the exact opposite, by the way. At the end of October, we were looking at evidence that was the exact opposite. It was pretty much everybody and their mother needs to come in and buy this market, and if it can begin to pop up in October, the evidence that we were looking at was that it could become a big feedback cycle of buying. Well, we are still in that feedback cycle of buying. That's what an uptrend is. Markets work exactly like this. It's a feedback mechanism, and that's what causes trends. Buying leads to more buying. The need and the reasons for the buying changes over time. It changes on the way up. It comes from, back here at the end of October, I think we had just seen like 15 out of 16 weeks in a row, Goldman Sachs, from Goldman, that hedge funds were shorting individual stocks, and it was the most on record or something like that. And that can begin as, well, the buybacks are coming in and the CTAs are forced buyers right now, which is beginning to break this market up, which then becomes a short squeeze at a certain point, which then causes the trend following algorithms as the trend changes to ramp up, to eventually it becomes performance chasing, artificial intelligence, you gotta own NVIDIA, stuff like that. And then so the mechanisms change, but it's still or the reasons change, but it's still a feedback cycle where buying leads to more buying as the market continues up. And then at a certain point, and this is the hardest part about trading, and this is why as a rule I don't like to call a top or a bottom. At a certain point though, it runs out. There is no next reason for that next buyer to come in. All the positioning is fully there. And then it still doesn't necessarily mean that the market has to go down. You need some sort of catalyst to come in. And that catalyst could be the VIX itself as a more technical thing, because it's getting above, as over the course of the last few days we've seen the market higher and the VIX move higher. Or that could be a news catalyst. CPI comes in hot tomorrow. I'm not saying it's going to. I have no idea. But if it were to, that could become your news catalyst that creates the technical impulse and then again all of the mechanisms I just described on the way up can happen in the exact same way on the way down, and the cycle potentially repeats over and over and over again over time. So it's just in my thought process, and again, I still have longs on, but the truth is every day that we go up, I'm selling those longs on the way up. I'm getting a little bit lighter, but I'm still respecting that this trend is intact. But I also need to respect all of this data and all of this information, especially when the market now gives me a technical signal that says that we could look for some sort of price correction. And we've got that technical signal today in the SPYs. We've got it in the Qs. We don't have it in the IWM, but the IWM is extended here. And to some degree, we have it in the semiconductor ETFs and the semis themselves, obviously. And I think that the semis have. I think if you lose the semis, like the other thing I was talking about in the morning meeting is I think that maybe not Apple, but I think that some of these mega cap tech stocks, the charts, they look fantastic. And if I was looking at Amazon this morning or on Friday without knowing any of the other information that I discussed, or without even being able to see the SPYs or the Qs, the shooting star and the SPYs and the Qs today, I would say, well, Amazon looks great, But I think that if you lose the semiconductor names, even though these charts themselves still look good, I think that they're going to get hit also. And if they get hit also, then again, that just circles back to exactly what I'm talking about, where now you can get a much bigger potential pullback in the Qs. Which, just to repeat what I said in the beginning, the Qs could pull back to 425 and still be healthy. They could pull back $10 from here, $9 here, and still be healthy. It's only at that point, it's like, all right, now we get a bounce off QQQ 425, then maybe you get a lower high that comes in at 430, and then you're actually starting to build out some sort of a reversal pattern. Yeah, that covers everything. The only thing I want to say about today's trading session, and I said it once during the VTF, is a lot of us, and I'm certainly guilty of this, we're very, very focused on the semiconductor short. And it's a hard trade. At the end of the day here, it's my second best name from a P&L perspective, and TQQ short's the only one that's better than it. But, trying to short this SMCI today, trying to short NVIDIA today, even though at the end of the day it worked, AMD today, which might have been the better one, was very, very hard, even if it was able to potentially work. Shorting Tesla today was easy. And we communicated this trade in the morning meeting as well. Here's a stock that's relatively weak. It's in a downtrend. So you're shorting with the trend as opposed to the semiconductors where you're going counter trend. With Tesla, it had bad news this morning. It's into a resistance area at 195. There was like 1,000 reasons to short it. And what we talked about in the morning meeting was being short versus the pre-market high. It worked great. It was just a little bit over 195. And I had been talking about for like a couple of days into this up move that the 195 area is the area where I would look to get short. The only reason I didn't short Tesla today was because I was just so heavy in the TQQQ and the SOXL short that I didn't think that it was honestly appropriate for me to add anything else on. So for me, it was really just more of a portfolio management decision than it was an actual trading decision. But I mean, this just so easy if you use that. First of all, we called the short into the chat when it was trading at 194 pre-market versus the pre-market high of 195 quarter. If you caught that, was super easy. We mentioned in the morning meeting, chasing 192 is a little bit tricky. So maybe if you can get a bounce, you could look at that short versus the 195 area. If you just purely shorted versus like in an intraday pivot, like if you shorted versus this high, I can't fault you for that if you got stopped out at highs. That just sucks, but I can't fault you for it. But if you stuck with the 195 or the pre-market high, or you got in early pre-market when we originally called it out into the chat, assuming that you didn't sleep in from a hangover from watching the Super Bowl too late, then this turned into just like a really, really easy short. It just was like capitulating down at certain points, and just like so much easier. Again, even with a little bit of trickiness at highs, so much easier to try to short that than to try to short this. It's like, all right, is this the signal? We can go for it. All right, is this the RDR? We can go for it. And again, kind of break-even trades. The inside and down here, this 5-minute RDR here, break-even trades. Patience, patience, patience. Okay, short verse here. Hopefully a break-even trade. Short verse here. Hopefully more than a break-even trade. So, it's kind of like, even though I wasn't trading these names individually today because I was just focused on the ETF, which I also mentioned I felt was the easier trade, it was similar to, when I don't remember which day that was, when I was trying to short NVIDIA on the way up, and I was just communicating with you guys about, not on the way up, but it was an update for it, and I was just communicating with you guys about, I'm shorting it on the way down versus a level on the way down. Okay, I got my risk covered. Okay, I'm stopped out. I think I did it like 7 times that day in NVIDIA. And I kept just getting my risk covered like every single time and then getting stopped out. And I think the last time I caught a move, but then it didn't close well, so I don't think I kept it overnight. Like that's how you have to approach it. If you shorted this SMCI off this like inside 5 and down and didn't stop yourself out at highs, yeah, it eventually broke lows, but I mean, did you blow up your account by the time it was at 810? Just brutally difficult, the counter trend stuff, compared to just being with the trend on a Tesla short. And I'm still not saying don't do it. I'm just saying that I think that this is the harder money. I think that if you're going to go after it, you have to go after it the right way. And if you're going to go after it, you damn well better make sure that you get paid for the work that you're putting in on a trade like this, if there is the potential of getting a move down to $700 or below, or $600 even off of that. where no one should be 100% out of their position, in my opinion, by 790 on the downside if you shorted this high. You're better off just almost not taking it at all, unless you're a very different type trader than me. If you're just a pure hyper scalper day trader or something like that, then what I'm saying probably doesn't apply to you. But I think that covers everything that I got. It was another very interesting, very exciting trading session to add on to a series of very interesting, very exciting trading sessions that we have had for the last couple of weeks now. So, happy to answer any questions anybody has. The ARM chips are from Carol. The ARM chips are very energy efficient and used in a whole lot of devices. They're also used in phones, laptops. Apple M1 chip is based on the ARM architecture, which is more powerful and less power consuming than, let's say, Intel. The chip technology, I think, will continue to grow. Yeah, for sure. ARM, just to talk about it real quick, is ridiculous at where it's trading. And Dimitri, I don't know if you have that on hand or if you're listening, but if you have it on hand, if you could repost that thing that you posted, the ARM Intel comparison, that was like super interesting also. And if you're not listening, okay, Dimitri's going to grab it for us. But, the thing you got to understand about this ARM, and this is so important because we see this happen with IPOs all the time. Like, what's that Vietnamese electric car company that we caught that move on that time for like a short day trader, couple day swing trade? Anyone remember the symbol? So I don't remember. VFA? Something with a V. VFS. Yeah, VFS. It's the same deal. Like, why was VFS able to run to $93? And why was I buying it on the way up at like 35 and then buying it again the next day at like 45? It's simply because it doesn't matter. Like the stock, I said it at the time when I was buying it at like $45. The thing is probably worth $3. But when you're dealing with these companies that are nearer to their IPOs, a lot of the float is locked up. Everything that's held by the insiders is all locked up, and there's various lockup periods, 3 months, 6 months, as an example, where the stock can be ridiculous and it makes no sense. But you know what? You just buy it anyway because the squeeze is on, and that's exactly what's going on here. But we knew it was a $3 stock at the time. ARM is similar, but in some ways different than others. ARM is probably a significantly more legitimate company than VFS. That would be the first thing that I would say. But at highs today, or whenever Dimitri posted this, ARM was nearing the same market cap as Intel, yet ARM's got $800 million in revenue and Intel's got $15 billion in revenue. And look, you could say the same thing about Tesla versus GM or Ford, and it didn't stop Tesla even after the lockups were expired, or just continuing to trade at ridiculous valuations compared to Ford. And honestly, again, ARM, because it's innovative and Intel is struggling in a lot of ways, probably deserves to trade at a significantly higher multiple than an Intel does. But SoftBank's got this huge holding, and that it's locked up. The lockup expiration is March 12th. So what I was saying this morning, even as I was looking to be very bearish in these companies, is I think I literally said, as scary as it is to short SMCI, I think it's significantly more scary to short this ARM. ARM at the inside and up, post that solid earnings report, but still with SoftBank being totally locked up and a lot of people not actually being able to dump shares, it's ripe in some ways for a VFS similar move. So it's just important to understand, and this all goes back to what I consider market dynamics in the market. You need to understand this kind of stuff, because if you don't understand that, you could be trying to short this thing all day and just be getting run over. This is a scary one. Yeah, and some of you guys I know are actually still long, like from the earnings day, and you just have a swing trade on. This is also what I talk about, right? Um, uh, I talk about it, like the good problem to have. The good problem to have, which I know a few of you guys had this good problem today, is that you're still long arm from the earnings report. We called out a long an arm, 2 trading sessions ago on the earnings report. Maybe you still have stock from underneath $100, and you sat through the inside day on Friday, and then this morning you're just getting the inside and up, and you're like, okay, hey, great. Now my long position's at $160. What a good problem to have. Should I sell more at $160 here because I'm ridiculously in the money and it's stupid extended? Or should I just keep following the trend and trying to raise my stop on a certain time frame and maybe my 160 becomes 220? I mean that's the same thing we were looking for back on that VFS. I think at one point I was like, it could go to $200 if it wants to. No, you have no idea where something like this was going to stop. You didn't know if it was going to stop at 55, 95, or $200. So, yeah. So that's ARM. and same thing. If anyone did short ARM today, Jim, I'm reading your comment, and you got stopped out. It's the same thing about what I was saying with this SMCI. Were you just shorting because you felt like the move was too big and you were just shorting it because the move is too big and it's got to come down, or were you shorting it on the way down versus a level, putting your risk on and allowing yourself to get stopped out, and then potentially looking to reassess off this shooting star and getting stopped out again? Okay, let me reassess. All right, big upside tail. I have now it's on the way down again. I have a level I can short versus the level. Like that's how you really need to approach. You got to approach this counter trend stuff like an absolute surgeon, because it is not forgiving. Counter trend trading is not forgiving, and I still would go back to what I say all the time, even as I'm here looking at evidence that's making me want to be more counter trend. It's just so much easier. 95% of the time, the easier, bigger money is just made by being with the trend. And then a very small percentage of the time, if you're a surgeon, you can short on the way down versus a level, manage your risk, let yourself sometimes get stopped out multiple times before you actually capture the trade. But then when you capture it, you can actually have a big payday counter trend. But it's got to be a much, much smaller percentage of the time. Cool. Having me type up Tesla. Gotcha. Happens. I've definitely been there, Jim. Jim just said I had too much size and thought the wind was in my sails, but it moved really quickly against me. I've certainly been there. I just got to learn to move on. Next question here is Fernando. I have a concern. How do you protect swing trades against an overnight sharp drop? Sure. So the way that I approach swing trades personally is I don't like. So first of all, I don't trade options, or hardly ever, very rarely. But you could get involved in options to protect your equity swing positions that you have at a certain point. But the way that I protect myself is by making sure that I have a big enough of a profit cushion in order to swing it to begin with, so that if there is a decent, a normal sized gap against me overnight, or large overnight drop potentially, like you're saying, all I'm doing is giving back profit that I've already made and not actually taking a loss. It's different if this is just bad luck. It can happen with you, it can happen against you. It's different if news happens overnight and you get a big gap against you and the news is unexpected. It's your own fault if you held it into an earnings report or some sort of news that was expected and a gap's really big against you. But, in the market, sometimes things happen. The market was closed, unexpected news was announced in one direction or the other, and it gap's really big against you. That can happen, but it should be an extremely rare situation, and in my opinion, actually not something that you should protect yourself for. I mean, you protect yourself by having the profit cushion, and honestly, that's also why I generally avoid trading single named biotech stocks, because that's where it always happens. It always happens in the single name biotech stocks. I think we had one this morning that gapped down 75% or something. I don't remember the symbol. I typed it up pre-market real quick as part of my research, saw that it was a biotech stock, and then moved on. But Pat had the news posted in the VTF. It was related to a drug trial failure. It's always a drug trial failure. You see that biotech stock gap down 70, 80, 90%, or sometimes gap up 300, 400%. So ANTX. Yeah, so like this is why I don't trade individual biotech stocks as a general rule. Think ANTX just gaps down 74%. Like, it's just a disaster. It's a total disaster. But otherwise, if I either make sure that my sizing, so generally what I really want is to make sure that I have a big enough of a profit cushion, like I was saying, to swing it, and then I'm good against any adverse effects of a big gap against me. I will sometimes, though I really don't recommend it to traders. I always have to be honest with what I do myself versus what I recommend to people and what I think the right thing to do is. I will hold swings against me if my sizing is appropriate, which is a really big risk. But what I'm certainly not doing if I'm doing that, which traders fall into this trap, is holding a swing against me, just hoping that it gets back to my price so that I can get out for no loss, in which case you have unlimited risk for zero reward. I can promise if I'm keeping a swing that is against me overnight, like I did with Soxel over the weekend, generally my sizing is going to be appropriate for me to do that if it were to gap against me further. And I'm also not getting out because my price is break even. I'm having a game plan in place to really make sure that I make money and that I get a profit from it. Cool. So I covered the questions I think in the VTF that are there for now. If anybody has any more, feel free to add them. There's a bunch of commentary here in the VTF. First, a question from Robert. Can there be something like a stock split for indexes? There certainly can for index ETFs, SPY, SQs, and IWM. I've never heard of, I don't know if we got any stock market historians in here, a split for like an actual index itself, like the S&P 500 or the Dow or something like that. I don't think that's ever been a thing. But the index ETFs can certainly do it. From Mike in YouTube. I started shorting SPY at 11.15 with the thought process of starting very small and building if more exhaustion comes. I ended up with a bigger position than anticipated, and without a planned objective stop, I capitulated before day high. Ugh. I struggled with seeing the extension continuing and leaning towards my idea being right versus managing risk because my game plan was definitely flawed. Yeah, I think that's what it comes down to. If you're doing this counter trend stuff, which we spent a lot of time talking about in today's afternoon meeting, it either has to be like I was explaining with SMCI and like I've done with NVIDIA in the past, where you are only shorting on the way down, you're doing it versus a level, and you are stopping yourself out and reassessing and looking for a new trade. Or you are so small, like you were saying, you started very small with the plan of building in with extension, but then you got bigger position than you anticipated without a planned stop. Somewhere in there you had a flawed game plan. Because I do that. But honestly, doing that type of trading, what you're describing, it generally honestly requires a little bit of a larger account size, which isn't fair if you work in a small account with a small account size. I know, but it is what it is. It generally requires working with a little bit of a larger account size and really making sure that your sizing is appropriate versus your account size to actually be able to continue to build in so that you're not capitulating right as the top is probably actually coming in, which I feel like a lot of people will tend to do if they're too heavy. So I hope that helps, Mike. Thanks for the commentary. From Gabriel, do you think the IWM might get taken down hard on a deeper pullback from the semis? Have some IWM and the Qs. I have some IWM name positions that have started to work nice since late last week, but I don't know if my game plan should be less greedy. Yes, that's been the big question. That's been the big question that I don't have a good answer to, and I've been posing it to the team here. Is I'm obviously looking for the Qs and the semiconductors to pull back. That's what I'm positioned for. Even as I'm repetitively saying that the trend is your friend and the trend is higher. The question that I've been asking myself, and it sounds like you're asking yourself the same question, and I really don't have the answer to it, is if you lose the semis, so we've got this breath situation, right, where breath is just garbage. If you lose the semiconductor names, does that just mean that you get a rotation trade? And that's what we saw today. That's what we saw today. Money just comes out of the Qs, it comes out of the semis, they buy up the IWM, they buy up IWM-related names, XLE, and maybe Growth Tech? Or is it just a sell everything situation in which everything goes down together? And I really don't have a good answer for you on that. What I've been kind of looking for is the rotation trade. That's what I've been talking about. It's what I'm positioned for as well. It sounds like you are too. But the truth of the matter is, even though I'm positioned for a rotation trade, I could really see that going both ways. I could really see it going both ways. I could see just everything taking a dump, or I could see the rotation trade actually coming in. Today was the rotation trade. It was again, at the end of the day, the IWM's up 1.8% and the Qs are down 0.6%. Does that give way at a certain point to just selling across the board? I genuinely don't have a good answer for you on that, or even a good thought process about why one option into a down move might be more likely than the other. From Apex Joy, when are good entries to nibble into short on some Bitcoin stocks like MSTR and CLSK? And also ARM. Well, we spent a lot of time talking about ARM already, so I won't repeat that. Oh my God, MSTR, Marit 27, CLSK. I don't really look at that one. Whew. They're sick. These are pure momentum names. You got to be very, very, very careful shorting them. So when is a good entry to do that? I have absolutely no idea. This $27 area is a big resistance area for this Mara. But I genuinely don't know. They're benefiting from the rotation trade where growth is improving right now. But the way these names could squeeze, it could be right here at 27, it could be at 30 for Mara, it could be at 40 for Mara. And then MSTR I won't touch this thing. It's like at least with Mara, it's a $27 stock. It's got a lot of liquidity. I can trade around a position. I can try to salvage myself if I'm wrong. This MSTR, if you're wrong on a $717 stock that has the ability to go parabolic to $1,000 with a super wide spread, just forget about it. So that one I would not touch. Maybe you could look at a Mara or a Riot at a certain point. I think it has less to do with, you're asking me about good entries to try shorting some. I think it has less to do with us just looking at the daily chart and trying to come up with a price, and more to do with what the intraday price action looks like when you can see some sort of upside capitulation come in or that pivot high to come in. And obviously you want to be watching like a Mara in conjunction with the Bitcoin ETFs. Thanks for the question. From Cyril, the 1320 bear bar on the Qs. Yeah, right here. Was to me a telling that we might see continuation to the downside. It was the biggest bar of the day at that point. Yeah, I was looking at was that when forget. There was some symbol that had like a big red candle in conjunction with the market doing that, and I kind of thought the same thing. Yep, just read your second comment. I agree. Gabriel, I wanted to short Tesla, but I forgot about it today. Yeah, I know. There's so much stuff on the radar. I get that too. How much percentage of your max size you start to build in the mean reversion trade position usually? Like when I'm first getting started on the short side, I don't have a singular answer to that. It depends. I think it depends on where I think we are in the cycle of extension and how early I think I could be. To be honest, like if I'm going to start to short counter trend and build in, as opposed to shorting heavier versus the level, the question really is how much of my maximum size am I starting with? And I don't have like a singular answer to you on that. I think it's very much dependent on the situation. Yeah, I don't have anything else for you on it. It's just an honest answer for you. Back over into the VTF from Ryan O. Can you talk a little bit about the importance of pre-market highs and lows? I'm struggling to pick the right stop. A stop where I know my idea is wrong, as you say. Once the market opens, my feedback to myself is I need to do better game planning. Keep the pre-market chart up or do better knowing the level. I find that once I'm trading, I'm defaulting to the low of the day, high of the day oftentimes as my stop, and I'm missing trades that work. It happened today with Tesla. So did you get pushed out? Yeah, you got pushed out on that with that high that I referenced earlier. So first thing I'm going to say is more often than not, the intraday levels are probably more important than the pre-market levels as a general rule. There's exceptions to that rule. One exception is if there's news that moved it and had to trade with a lot of volume pre or post market. There could be a little bit of an exception with certain stocks that just tend to trade more pre-market, like the SPYs or the Qs or Tesla or Apple. But most names, it's not as worth it. I'm referencing the pre-market like high or low as a stop loss oftentimes when we're doing the meeting and the market hasn't even opened yet because I don't have anything better. I don't have anything better to use. There's not a better daily spot, or the better daily spot just too much risk. The thing about Tesla specifically today is that the pre-market high coincided with an important daily level, right? So that's why I think that was more important. Though I did say when I was reviewing Tesla, even before I knew that you traded it, I can't fault anybody who was short versus high and basically got stopped out at highs because I don't think that there's anything wrong with doing that. I think that you traded it just right, and I'm glad you got your risk covered. And it's just unfortunate that it pushed you out before it actually went. So most of the time, if I'm starting with a pre-market stop, it's probably because I'm executing my trade within the first 5 minutes of the open or even before the market actually opened. And then once it's opened, I want to revert to an intraday stop. So another thing that you could have done, which I wouldn't have faulted you for, is maybe you were short when we typed it into the VTF very early this morning. Maybe you were short pre-market Tesla at 194. I called it out on the way down here as Dimitri was posting the news in the morning meeting. So you could have been short pre-market versus 194 versus this high, had $1.30 risk. Stock is working its way down. Great, you get your risk covered. Stock opens up as the day opens here. This big pop comes in. It works its way down now. This would be even better if it broke lows, which it didn't. But now you're like, okay, I can lower my stop from my pre-market stock to something intraday. I do that all the time, in which case you would have gotten stopped out. The one big difference, though, just to repeat myself, I think with this Tesla situation specifically, is that the pre-market stop coincided with the daily level. And when I can, I prefer to use daily levels. If you're using a daily level, then you really know that you're right or wrong. The problem with using a daily level is that it messes up, it makes it so that you have, most of the time, not always, most of the time it can make it so that you have a much worse risk reward because you're giving it so much more space risk because you're giving it to the daily chart. I love when I'm able to combine something that's intraday with the daily, because then that means I'm probably having better, tighter risk, but getting to use that really important daily level where I really know my idea is wrong. And that's kind of what coincided with Tesla today. Is I in many ways prefer your stop loss where you got stopped out, and it's unfortunate, and that's why I said that earlier. But not when, just for an extra, and obviously it depends on when you executed your trade and everything else and the type of trade you were looking at. But for me, a little bit bigger picture, that extra dollar to be able to coincide, or not even 80 cents worth of space risk in a name like Tesla, to be able to coincide more with the daily level, which coincides with the pre-market level, I prefer that. I hope that helps, Ryan. Fernando wants to know why I prefer to trade stocks instead of options. Sure. I trade in a proprietary trading account, not a retail account. So in a proprietary trading account, I can get all the leverage that I want. I think I've discussed it with you, Fernando, in the past, where if you're in a proprietary trading account with one of our entities like T3 Trading Group or T3 Global, on the equity side, we provide buying power usually starting at like 20x intraday and 8x overnight. As opposed to if you're in a retail account, you're regulated to Reg T margin, which is 4x intraday, 2x overnight, or possibly portfolio margin, which is 6.25x. But what you don't realize is that Reg T margin and portfolio margin on top of that comes with a bunch of haircuts. So honestly, portfolio margin really usually turns into more like 4x and 6.25x. So in a retail account, a lot of people will trade options, and this makes a lot of sense, basically for leverage, because options are a naturally levered product. So since you're subject to the restrictions of Reg T or portfolio margin from a leverage perspective, you turn to options to get extra juice. I don't need to do that. The problem with options as a directional trader, and that's what I am generally, the problem with options as a directional trader is they are less liquid than the underlying equity. You can have more slippage on your entries and definitely more slippage on like a stop loss going off. They're less liquid, and they are also subject to decay, which can work in your favor potentially also if you're selling, but selling is tricky because if you're like naked on the selling side, you could be exposing yourself to a ton of risk. So my thought process has always been, I'm a proprietary trader. I already have all the capital access, all the leverage access I could ever want. Why would I trade options, which are a less liquid product and subject to time decay? Just for capital access, it doesn't make any sense. And that is what makes prop trading superior than retail trading. The exception to that is people who trade more complex option strategies that cannot be replicated in the equity market. If you're trading more complex strategies, if you're doing, some sort of spreads or things like that, that can't be replicated in the equity market, your entire edge then could be based in options, in which case then you should trade options, and that's why T3 in our prop trading accounts we also enable traders to trade options, and we offer a leverage on options trading, a premium there that is also more significant than what you can get in a retail account. So for those people, then they should be trading options and they shouldn't be trading stocks. But for someone who is more of a directional trader like me, it's going to be much more beneficial for me to trade stocks. So hope that helps. All right, cool. Looks like I got through all of the questions in the VTF and on YouTube. Today was an incredible day. Hope everybody was able to do well. Hope everybody's learning. Have a great night. I'll see you all tomorrow.